Good morning from sunny and mild Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. I hope those who celebrate are having a nice Easter Passover weekend. Thanks for viewing our latest Following the Money bi-weekly podcast. Today is Sunday, March 22nd, 2026. Since I was with you last exactly 2 weeks ago, the U.S. stock market has been highly volatile, driven primarily by geopolitical tensions in the Middle East and their impact on oil prices and inflation expectations. Markets initially declined as rising oil prices fueled fears that inflation would remain elevated and delay Federal Reserve rate cuts. This was followed by sharp headline-driven swings with rallies on signs of de-escalation and sell-offs when the tensions intensified. Despite the turbulence, stocks staged a strong rebound in the most recent week, posting their best gains of the year. Overall, however, the market remains in a fragile, late-cycle environment where oil prices, interest rate expectations, and geopolitical developments are the dominant drivers. In just a minute or so, we're going to look at some key charts, some important data series, and some of Asbury Research's own data-driven models pertaining to current market conditions. Before we do, let me just take a minute to tell you a little bit about Asbury Research. Asbury is a registered investment advisor. We've been providing investment research to both individuals and professional money managers since 2005, which makes this our 21st year in business. We utilize what we call dynamic diversification or intelligent diversification, as opposed to static diversification, or what I call it set it and forget it diversification, which is typically the standard allocation program for most advisors. The advisor asks you a list of questions, they're canned questions that they ask everybody in the beginning of the relationship. And then based on what answers that you give them, you're set up on some variation of a static 60-40 stocks and bonds portfolio, maybe with a little gold thrown in, maybe with a little global equities. And that's supposed to protect you under all market conditions. The problem with the strategy is that it doesn't work very well because, like old-fashioned cruise control in your car, some human intervention is necessary to keep you from killing yourself. It's the same in the markets. For example, both stock prices, bond prices, and gold prices all declined at the same time throughout the month of March. If you prefer to manage your own investments, we have 2 levels of research service available. We have our flagship Asbury Premium. It's for more serious investors. It includes the updates on all of our models. You can find out more about this service by clicking the Research tab, which is right here up on the screen at the top of the webpage at asburyresearch.com, and can request further information, including pricing, via the Contact tab, which is just a little bit over here to the right. We also have our entry-level Substack newsletter for $25 a month. There it is right there. And that does not include any of our trading models, but offers selected reports and models from our premium research product. You typically get about 3 reports a week. There's even a special report there. It's a quantitative model that we built specially for the Substack that I'm going to show you a little bit later in the broadcast today. There's also a free version of the Substack. So if you like our videos, you like our approach to markets, you like to watch us on YouTube, but you're not ready to commit to a paid service, I strongly suggest that you sign up for the free version of the Substack here. You could do that at asburyresearch.substack.com. It's a no-brainer. Feel free to come and visit anytime and sign up for this free newsletter. If you prefer a managed account, we have created 4 model portfolios using our own proprietary models like the Correction Protection Model, or CPM as we call it, or the CEIF model as building blocks for the purpose of participating in the market with less risk. These model portfolios have all been developed through rigorous 8-year backtests and have been trading in real time for almost 2 years now by both individual investors and professional money managers. These model portfolios are designed to produce S&P-like performance, but with significantly less risk, or to produce relative outperformance versus a broad market, but with similar or slightly lower risk than that of the S&P 500. Through the first quarter of this year, all four of the model portfolios, which are Asbury Aggressive, Asbury Balanced, Asbury Conservative, and Asbury Ultra Conservative, they're all outperforming the S&P 500 by various degrees and all with less risk. If you'd like more information about these model portfolios, you can click on Managed Accounts. Again, going back to asburyresearch.com, you click on the Managed Accounts, select the portfolio or model portfolios that you're interested in, and we will respond. Of course, past performance does not guarantee future performance. Full disclosure, all of my own equity-related investment dollars are all invested solely in our Asbury Research models and model portfolios. Okay, let's get down to the reason you're here and look at some charts together, some data, and some of our own models. So we're going to begin with the correction protection model. So we're moving into the research center. This is the password protected part that you would see if you were a premium subscriber. And here's the CPM model right here. We have been risk off as of March the 3rd, as you can see. The CPM is a dynamic stock bond allocation model that's meant to replace the static 60-40 portfolio. Let's take a look at a chart real quick. So AOR here is an ETF that mimics the performance of a 60-40 bond portfolio. That's in blue. This starts in Q4 of 2017, which is where most of our back tests go to. That's usually the starting point for us. It's a little bit over 8 years back right now. This is CPM in green. So you can see the wiggles are the same, but you can see we really broke away from AOR, or the 60-40 portfolio, back in the first quarter of 2020, and we continue to get wider between the two lines, which means it's outperforming. So the reason I showed you AOR is because if you're just in the S&P 500, there's no risk control. You buy them and pray. AOR does have quote-unquote risk control because it's a 60-40 bond portfolio, which I've already stated really doesn't work well all the time. Doesn't work well really a lot of the time. CPM has risk control. Since 2017, CPM averages, let's get back to where we were. So I want to show you a chart here in just a second. Since 2017, averages 5 round trips a year. Not set by the calendar, but we're making our moves in and out based on what the market's doing. So when CPM is risk on, we're in the S&P 500. We use SPY for that. When we're risk off, as we are now and have been since March the 3rd, we are in BIL, which is a ETF that mimics the yield of a 1 to 3 month treasury bill. It's provided S&P-like performance, but with about 40% less risk according to maximum drawdown, standard deviation, and beta. The maximum drawdown during this period for the S&P 500 was 34%. That was during COVID. Maximum drawdown for CPM has been 20%. So again, significantly less risk, very similar performance. Year to date, the CPM has outperformed SPX, or the cash S&P 500, by 6.5%. Here's why drawdowns are so important. As you can tell, I'm an older investor. I'm in my 60s, and the game changed for me once I started getting into my probably middle to late 50s, and it was important for me to not give a lot back, because now the clock becomes a part of the equation. Just like when you're playing football, you play football game in the fourth quarter with a lead differently than you might in the first half, because you want to retain your lead, possibly build on your lead, but you don't want to give it up. So what we're going to look at here is, this is CEIF. So we're going to go back to drawdowns, actually. I'm going to get to the CEIF one in just a second. Drawdowns. If you draw down 10%, just the way the math works, you have to make 11% back the other way in order to get to where you were. The one I like to use in this example is the third one here, this pair, let's call them. The S&P drew down 34%, as I said, during COVID. So if you draw down 30%, you need to make 43% back the other way. If you're lucky, you'll get that 43% back the other way relatively quickly. That's what happened in COVID, but that's not the norm. That doesn't happen all the time. If you're 65 or 70 years old or 75 years old and you drew down 34%, what if you got to wait 5 or 6 years to get back to even? That's why this is so important. And when we're looking at CPM, this is going back to 2018, showing the max drawdown in the S&P 500 for that year and the corresponding drawdown for CPM. So you can see in 2018, it was 4.5, almost 5% difference. S&P drew down 19.8, CPM drew down 15.10. But when you factor in compounding, that adds up as you go year by year by year following the model. Here's COVID. 33.9% was a drawdown during 2020. The S&P 500 only drew down 9%. So that was a big deal. That was a big deal that year. You can see some years, not a whole lot of difference, 2023. But again, compounding, drawing down less so you can get back to making money quicker. Last year, 18.9 was the drawdown that we had between February and April of 2025. CPM drew down 9.3%. So that's why it's so important. CPM is a component of our 4 model portfolios. Now we're going to go to CEF. The CEF model right here, CEF stands for Sector ETF Asset Flows. What CEF is it's an alpha generating sector rotation model. What it's meant to do is replace that part of most investors' portfolios that stays in the market all the time. I'm one of those guys, even though I used to trade on the trading floor for 17 years at the CME. As I'm older, I'm a little more conservative. I like to keep a chunk of my money in the market at all times. That's what the CEF model was meant to do. But instead of putting it in the S&P 500 and letting it work, we have built a model that here we go. What CEF does is we built an equation. Let's go down and have a look at the graphic. I built an equation, an algorithm that measures the velocity of money that moves around the 11 sector spiders, which if you put them all together, they're the S&P 500. Through a lot of back testing, trying to figure out how we could squeeze the most juice out of this model, we found that the best performance and the best defensive numbers were attained when we're always invested in the top 3. So let's say we've got a hypothetical $100,000 trading account, investment account that we want to follow CEF with. We're always invested in the top 3. So going into this week, the top 3 are utilities, XLU, energy, XLE, and technology, XLK. Next week, this is always rebalanced on the weekends. So next week, let's say XLK falls out of the top 3 and materials moves into the top 3. All we'll do is that following Monday, we will sell out our XLB at the market. Again, because it's rebalanced on Saturday. It's usually available to our premium subscribers by about midday on Saturday. So we'll sell out XLB the following Monday at the market and we'll replace it, or XLK rather, and we'll replace it with XLB. So there's not a lot of activity. And it's in almost all cases, it's almost on the open on Mondays or whatever the first day of the trading week is. Latest signals, as I showed you, XLU, XLE, XLK. CEF performance since inception. Let's have a look at that. We were there for a second before. We'll go back to that chart. And there we are. This is this particular back test. It goes back to 2018 based on the availability of the data. But you can see CEF slowly pulling away in green from the S&P 500, which is in blue. CEF is a component of all 4 of our model portfolios that I had mentioned earlier, as is CPM. The next thing we're going to do is go back to the research center. We're going to take a look at our ETF trade ideas. Now, we don't have any open ideas right now, but what I wanted to go here just for a moment is to show you the methodology, the thought process that goes into this. So we, going back up to the top here, the table below lists sector and industry group ETFs. There's about 6,600 of them that we scan every morning, early in the morning, and we look for positive price trends. We look for relative outperformance versus the S&P 500 or whatever the benchmark might be for that particular ETF. We look for expanding investor assets. And then finally, we look for attractive risk-reward ratio. That's the only subjective part of this. And that's, from my doing this for 40 years, that's kind of my job, is to look to make sure that we're buying breakouts. We're not buying acceleration into a resistance level up top. But again, it's a very rigid process. We follow it every day. We're huge believers in staying away from seat of the pants trading, or looking up at CNBC to see what some guy is saying and making a move, or getting scared out of a good position because you're letting outside forces turn your brain upside down. That's when you make a lot of mistakes. So almost 3 years, have 120 trades that we put out, 120 trade ideas. 54% of them were profitable. Our average profitable winning trade is 5.5%, and the average length of those winning trades is about 20 trading days, or just shy of a trading month. Average losing trade is only 2.4%, and we're in those trades about 8 business days, or about a week and a half on the calendar. Ratio of average winning trade to losing trade is 2.3 to 1, and our Sharpe ratio throughout the 3 years is a pretty stable 1.4%. Very hard to do. So that's our approach to going out and picking individual ideas, rather than, we think the earnings is going to be better, or this tweet or whatever it is going to help this to make money. To me, that's throwing darts. This is very mathematically oriented, very systematic, and very easy to follow if you've got some discipline. Last thing we're going to do, or second to last thing we're going to do, keys to this week is our weekly overview of the market. We probably look at 100, 130 charts, 150 charts, and we pick out 10 that we think are very germane to what's going on right now, and we're going to look at a couple of those. So headline is new major downtrend being tested by this week's rally. And here's our first chart. This is the S&P 500, daily going back to July. And what we see is on March 19th, we broke down through the 200-day moving average after testing it for a while earlier in the month. And then we had a strong rally at the end of last week from another one of many tweets or public announcements that the war is going very well and we're going to be out of it in a couple of weeks. We fell shy of the 200-day moving average. To us, that's where the resistance is right now. If this was just a bounce in an emerging move that's going to go lower, we should fail somewhere in the neighborhood of, I'd say, 66.44, which is where the 200-day moving average is. In order to confirm for us that this move down is over, and March 8th, by the way, is right about just eyeballing it, right in here somewhere. This is where CPM went to risk off. So we went to risk off here, and we missed a lot of this move down. We would need to rally above 67.20 to 67.82 back on the top side in order to suggest to us that this move down is over, and we're starting to resume the bigger uptrend that we began back in May of 2025. Chart number 2 is another one I want to look at. This is NDX, and the NDX is important, which is a NASDAQ 100, because it typically leads the market both up and down. You could see here we broke through the November 12th benchmark low, and the 200-day moving average within about a week or so of each other. And now we're coming back up to possibly test the 200-day moving average as a major overhead resistance level. 24,446 is the price. More importantly for me, since December the 11th, NDX has been underperforming the S&P 500 down here in the lower panel since that time. We've had a couple of tests of it in late January, in the middle of March, but if technology or the NDX or the composite index are underperforming the S&P 500, that in most cases corresponds with a weak broad market that is going to go lower. So I'm going to be watching this relative performance chart here closely next week to gauge the strength of the NDX relative to the S&P 500. Next one I want to look at is Apple. Apple has had a very tight linear correlation to all three, S&P 500, the NASDAQ Composite, and the NDX for 25 years. Tight and stable throughout the entire series. We broke out of this investor indecision area on March the 5th. Now we're testing the 200-day moving average. But this breakdown, as long as we stay underneath 274.22, targets have moved down to 225. That's about 11 or 12% lower than where the market is right now. So Apple has a downward bias to it. We know where the risk is. On the upside is 274.22. So I'm watching 249.13 to 243.42, which is the 200-day moving average and the benchmark low that we made on Jan 20. If we break that, the likelihood of getting to 225 gets a lot bigger. Finally, we're going to look at chart 7. And here's investors' intelligence data. This is one of several investor sentiment indicators that we track. We are actually one of the inputs. The investors' intelligence people are friends of ours, and we supply them with our signals to use for their sentiment data. So what we see here is this indicator peaked with a most bullish. Now, these people, I should mention, these are what they call newsletter writers. I don't think anyone actually writes a paper newsletter anymore, but they're basically independent research shops like ours. That's who they poll. So they were as bullish as they have been recently on February the 6th. It was a week after we peaked on Jan 28th. And we're still moving down towards opposite least bullish. It tends to work kind of in a sine wave. It goes to most bullish, it goes to least bullish, and then it starts to recycle again. Note what's going on here since 2015. All these big bottoms didn't occur until we were down to least bullish extremes. It happened in April of last year, October of 22, March of 2020. That was a COVID bottom. You had another good important bottom in December of 2018, February of 2016. That's what all of these bottoms have in common. This metric is still moving towards that extreme. So again, this is not quantitative. I think it's a little bit more subjective. But what it tells us is the market is not least bearish enough. It isn't, or least bullish enough, or flip that around. It isn't bearish enough to really produce a bottom. So that's just something that we've keeping in the back of our head. Finally, let's take a look at our Substack entry-level product that I had mentioned to you before. So here it is. And we'll begin by looking at our sort report, which is one of the components there. And here is sort. And we'll click this and make it a little bit bigger. So what we've got here, this is exclusive to the Substack product. We have, excuse me, I think there's 10 of these, 10 different broad asset classes: commodities, US dollars, US small cap, global equities, ex-US, crude oil, emerging markets, interest rates, US interest rates, gold, crypto, and US technology. We track these or we rate these according to 3 different criteria. Their trend. They need to be in a positive trend. Relative performance, they need to be outperforming their benchmarks. And money flows, their AUM inside of that ETF has to be expanding. When all three are green, that tells us in this big broad category, these are places to look for opportunity because we've checked all the boxes. There are 4 of them right now. It's commodities, US dollar, US small cap, and global equities ex-US. We use a ETF called SPDW for that. This metric tells you how to or where to look for opportunities. I think this is updated twice a week for our Substack customers. So let's go back to where we were. And one more thing I want to show you. Our chart focus. This is once a week, typically towards the end of the week. And this is very similar to Keys to This Week that I just showed you. It's a broad overview of what's going on in the market. You can see here we have an economic paragraph. Economically, when the S&P 500, I'm right here, and NASDAQ Composite are declining, tech stocks are underperforming. The broad market, tech stocks, I should say, are underperforming the broad market S&P 500. Stocks are underperforming bonds. Energy, utilities, and materials are outperforming, as I mentioned, with SEAF. Long-term interest rates are rising, and small cap and value stocks are outperforming. This describes a fairly specific and important market regime. This combination most closely aligns with a late cycle environment that is drifting towards stagflation or policy stress. So this is how we look at the market. We're basically measuring the market technically and quantitatively, and then basically putting it into the computer and having it tell us what kind of a regime that we're in. So let's go back to where we began, and let's wrap it up. So that's our latest Asbury Research Following the Money. We're going to have another one tentatively scheduled 2 weeks from today on Sunday, April the 19th. Hope to see you then. In the meantime, if you have any questions or want more information on any of our research subscriptions or managed account services, you can contact us right here via the contact tab at asburyresearch.com. See you in 2 weeks. Enjoy some nice weather as we're getting into spring now and a brand new baseball season. My Chicago White Sox have their home opener this evening. Go White Sox, and make sure you like and subscribe. We'll see you in 2 weeks.